Women. The topic for today is assets disposals. In it, we will be discussing depreciation and more. Let us discuss fixed assets, or basically asset disposal. Let's start with the main definition, which is what is an asset? An asset is a resource that we use to generate money, to keep it simple. And for grade 12, 10, 11, assets will be recorded at cost price, plus any cost incurred in bringing the assets into conditions ready for it to be used. The asset will increase and decrease at cost price. The actual asset will increase and decrease at cost price. That is because assets will always be recorded at cost price. The asset will increase at cost price plus directly attributable cost when it is purchased and decrease at historical cost when it is sold. Now, what is this directly attributable cost? Let's say you buy a plain laptop for 10,000 rand. It comes plain, so there are no programs installed. Now, if you want it to work, you will have to include some sort of an operating program. For example, like Windows. Now, to buy Windows and get it installed into that laptop, let's say it costs you 3,000. And without Windows, that laptop won't be able to work. Let's say you use the laptop for business purposes. Any cost that is going to make sure that laptop can be used for business purposes so that you can make money, any cost incurred will be added to the cost price of that specific laptop. We're talking about programs like Windows, Excel, Microsoft, all of them. The cost you incur for those programs, we call them directly attributable costs. Directly attributable costs include transportation or delivery costs from whoever you purchase the laptop from to your business. Every asset that is purchased will have to be recorded in what we call an asset register. For control purposes and internal control purposes, this register is vital. It enables the business and whoever is interested in the financial affairs of the company to trace all the assets of the business. And I think that's where, if you have watched Steinheist, and if you haven't watched it, please make sure you watch it because it's very important. Assets were not traced to the extent that fictitious assets were recorded that didn't even exist. Like that farm that was considered to exist, it didn't exist. That Marcus Eustace came up. Now, when you have an asset register, it enables you to trace, for control purposes, to trace and ensure that that asset actually exists. So in your asset register, you record all the assets of the entity and all the movements relating to the assets will be recorded in this book. When we talk about movements, we're just simply talking about three things. Any assets purchased, depreciation on that asset, and any assets sold. And each asset will have detailed explanations about additions, depreciation, and disposals. Remember, depreciation is the cost of using that asset. In a way, depreciation is the conversion of part of that asset into an expense. So every asset, as it is used, it is converted into an expense. The part of an asset that is used is an expense. And that expense here, we call it depreciation. As we recognize this depreciation, we will debit the expense, which is depreciation, but we will credit accumulated depreciation. We don't credit the actual expense. We only credit accumulated depreciation, which most of the teachers normally say it's a negative asset. I don't like calling it a negative asset. I simply call it a valuation allowance. It enables you to determine the accumulated decreases of an asset or how much in total of the asset has been used or expended. So accumulated depreciation increases on the credit side. To depreciate an asset, it will normally be based on the economic useful life. For how long do we expect to generate money from this asset? So an economic useful life, it is a period over which the entity expects to use an asset in order to generate economic benefits, that is cash for the business through sales, resulting from the usage of this asset. The useful life is determined by the period over which an entity expects assets to generate inflows of economic benefits. Know that depreciation is a rate that is determined based on the useful life of the asset. It is important to make sure of the following facts regarding fixed assets before the sale of an asset. Make sure that assets are recorded at cost price and you recognize what we call accumulated depreciation. Accumulated depreciation is basically the total of depreciation written off on a specific asset based on the asset's useful life or any depreciation method considered to be appropriate for that specific asset. Accumulated depreciation is considered or regarded as a valuation allowance for an asset. As a result, it affects the asset negatively, as it has a negative or credit balance in the statement of financial position. Accumulated depreciation, as I have explained, increases on the credit side. Depreciation, as I said, it is how much of your asset has been used. It reduces economic benefits you expect from using the asset. I mean, you still expect from the assets. Therefore, accumulated depreciation is the accumulated decreases of the asset's future economic benefits. That's why accumulated depreciation increases on the credit side. The book value of an asset, as I've mentioned here, it'll be the cost price less its accumulated depreciation. When we calculate depreciation, it'll be based on two methods for now. When you go to grade 11 and 12, it'll be different. It'll be three because we have what we call units of output depreciation method. I will start with your diminishing balance, reducing or carrying value or book value method. It's one and the same thing. When you calculate depreciation using this method, you will take your depreciation rate determined based on the useful life of the asset. You will multiply it by the carrying value of that asset. Then you get your depreciation. So under diminishing balance method, to get depreciation, you take the carrying value of the asset you multiply it by the depreciation rate. And then you multiply by the number of months over which you use the asset divided by 12. The reason why you divide by 12 is because your depreciation will always be per annum. So it's for the whole year. Basically, if for the current year, depreciation or an asset was only used for 8 months, it'll be wrong for us to recognize an annual amount as our current year depreciation. It doesn't reflect how much of the asset has been used. That is why we have to multiply by the number of months over which we use the asset divided by 12. Carrying value will be cost price minus accumulated depreciation. It's also called the book value. As I've said, depreciation using diminishing balance method will be calculated on the carrying value of an asset. You need to make sure you calculate depreciation of an asset up to the date the asset is sold. You only stop depreciating an asset on the day you stop using the asset. As I've said, carrying value will be the cost price of an asset minus its accumulated depreciation. Note that the accumulated depreciation is the sum of all the depreciation of an asset from when the asset was purchased up to a point in time, which can be up to the date of sale or up to the beginning of the current financial year, or up to the end of the current financial year. But it is the depreciation that you have added up from when the asset was purchased up to the current period or the present. That is the first depreciation method, which we call diminishing balance method, or reducing balance method, or book value method, or carrying value method. The second method for calculating depreciation will be on cost or straight line. Here, depreciation is calculated on the cost price. You will take the cost price of an asset, you multiply it by the depreciation rate to get depreciation for that year. Depreciation here will be calculated, as I've said, by taking the cost price, multiplying by the depreciation. Let us look at this asset register. I have completed a couple of things. I will give you the purchase date. I will also give you depreciation method, depreciation rate, as well as the cost price. Let's start with the first year. And I will give you the first year will end. The end of the year will be the 31st of December, 2017. How do we record depreciation or calculate depreciation? Note that the vehicle here, obviously it's a vehicle, it's a double cab Ford Ranger with that registration number. Depreciation is on cost. Depreciation rate is 20% per annum, highlight per annum. And the cost price is 650. I told you what depreciation method we have to use will be, which will be on cost. So to calculate depreciation for that year ends on the 31st of December 2017, meaning that it started on the 1st of March 2017. I mean, the 1st of Jan 2017. That is 12 months. We've used this Ford Ranger double cab for 12 months, the whole year. Because we have used it for the whole year, we have to depreciate it over 12 months by taking its cost price, which is 650,000, multiplying it by the depreciation rate of 20%, and then multiplying it by 12 over 12, which represents we've used it for 12 months out of the 12 months, which comes from that per annum. Depreciation for the first year of usage will be 130,000. Accumulated depreciation in the year you purchase the asset will be the same as depreciation for that year. To calculate carrying value, you will take the cost price and subtract accumulated depreciation. It'll give you the carrying value of 520,000. The second year will end on the 31st of December 2018, meaning that we have used this vehicle from the 1st of January 2018 up to the 31st of December 2018. We've used it for 12 months. When we depreciate it, we will take the 650 times it by the depreciation rate of 20% and multiply it by 12. It'll give us depreciation for that year, which will be 130,000. Remember, accumulated depreciation is the sum of the depreciation of that asset for as long as we use it. You recognize depreciation and then you add it to accumulated depreciation. For the year ended 31st December 2018, our accumulated depreciation will be that 130,000 plus 130,000. So accumulated depreciation is increased by depreciation. 130,000 plus 130,000 will give you, for 2018, our accumulated depreciation. To accumulate means added depreciation will be 260,000. To get carrying value for that year, you will take the same 650 and minus the 260,000, it'll give you 390. Or they asked this in one of the government papers. You can take previous year's carrying value and just subtract current year's depreciation. So you can just take this carrying value of 520 and minus current year depreciation of 130. It'll still give you that 390. For the year ended 31st of December 2019, how do we calculate depreciation? Still, take the cost price times the depreciation rate of 20%, times it by 12 over 12. Remember, this 12 in the numerator represents for how many months was that asset used in that year. So it was used for 12 months. The 12 in the denominator represents the fact that your rate, which is 20%, is per annum. Per annum means it is for 12 months. Now you will take 650 times it by 20%. It will give you 130,000. How much will be our accumulated depreciation for the year ended 31st of December 2019? For that year, our accumulated depreciation will be 130, and it will be 390, which is the 260 from the previous year plus the current year depreciation of 130. To calculate your carrying value, you still take the cost price, which is the 650. You minus this 390. It'll give you your carrying value, which will be 260,000. Or you take the 390 from the previous year, you minus current year depreciation, it'll give you that 260,000. For 2020, to calculate depreciation, you will still take the 650 Because we're using the cost method, depreciation will always be recorded or calculated on the cost price of that asset, which is the 650. Take the 650, times it by 20%, times it by 12 over 12. It'll give you depreciation of 130. Accumulated depreciation will be 130 plus 390, which will give you 520. 650 minus 520 will give you 130. The following year, which is the 31st of December 2021, when you calculate depreciation, it will be the same. 650 times 20% times 12 over 12, which will give you 130,000. Accumulated depreciation will be that 130,000 plus the 520. It'll give us a total carrying value, accumulated depreciation of 650. So the cost is still 650. So 650 minus 650 will give us 0 as the carrying value. In accounting, though, the carrying value represents how much of that asset can you still use to make money. And for any asset, it's impossible for you to say that you can't make any money from that asset. So even if you have used most of that asset, in accounting, your carrying value must be limited to 1 because that asset has a potential of being used somehow. Even worn out bicycles that are rusty can still be used for decorations to make money, obviously. That's why for all your assets, the carrying value can only be up to 1. It cannot be equal to 0. So now we have to adjust this year's depreciation. It cannot be 130,000. Question is, how do we adjust it? Since it will result, if we recognize the full 130,000, it will result in our carrying value being good and we can't afford it. This is what you're going to do. You are going to check what the carrying value was in the previous year. How much was it? The carrying value in the previous year, which is December 2020, was 130,000. It means current year depreciation will be limited to that 130,000, which is the carrying value from the previous year, minus 1, which is 129,999. That will be your depreciation. Meaning that your accumulated depreciation will be that 520 plus this 129,999. It'll give us 649,999, ultimately giving us a carrying value of 1. Let's move to this one. This is when this asset was purchased, depreciation method, depreciation rate, as well as the cost price. I will give you the end of the first year, which is the 31st of December 2017. For that year, we used this asset from January, February, March, April, May, June, July, August, September, October, November, December. So we use it for 12 months. So when I depreciate, I will take the 250 times it by 20% times it by 12 over 12, which will give us 50,000 rand. Accumulated depreciation in the first year will be the same as depreciation. Carrying value will be 250 minus 50,000 will give us 200,000. The following year will be the 31st of December 2018. When we calculate depreciation, you need to pay attention to the depreciation method. They said that the depreciation method is diminishing balance method. So diminishing balance method means current year depreciation will be calculated using the closing balance of the carrying value from the previous year. Closing balance for the carrying value from the previous year is 200,000. You will take that and multiply it by 20% and multiply it by the period over which you use the asset in the current year divided by 12. But in the current year, we've used it for 12 months. So that's why we multiplied it by 12 over 12. Depreciation for 2018 will be 40,000 Rand, increasing accumulated depreciation to 90,000 Rand. How did I get that 90,000 Rand? It is the 50,000 Rand, which is the accumulated depreciation from the previous year plus current year depreciation of 40,000 Rand. To get to this year's carrying value, we are going to take cost price minus accumulated depreciation at the end of the current year, which is 90,000 Rand. So 250,000 minus 90,000 Rand, that gives us 160,000 Rand. For the year ended the 31st of December 2018, when I calculate depreciation, I am going to take last year's carrying value, which was that 160,000 Rand multiplied by the depreciation rate of 20% multiplied by 12 over 12. It'll give me depreciation for that year, which will be 32,000 Rand. You're going to take that 32,000 Rand for the current year depreciation and add it with the closing value of your accumulated depreciation of the previous year. And that was 90,000 Rand plus 32,000 Rand will give us 122,000. Dotted them right there. So when you calculate carrying value, it will be that 240,000 minus 122,000. And that will give us the carrying value amounting to 128,000. What do we do next? How do we calculate depreciation for the year ended the 31st of December 2020? You will take carrying value from the previous year, which is 128,000, and multiply it by depreciation rate of 20% times it by 12 over 12, which will give you 25,600. Accumulated depreciation will be 122,000 plus 25,600, and that will give us 147,600. To calculate carrying value, you will take the 250,000 Rand minus that 147,600, which is always cost price minus accumulated depreciation. That will give you 102,400. Or you could have taken 128,000, which is the carrying value from the previous year, you minus current year depreciation of 25,600. It'll still give you that 102,400. For 2022, to calculate depreciation, you will take last year's carrying value of 102,400 multiplied by the depreciation rate of 20% multiplied by 12 over 12. It will give you depreciation for the current year, which is 2021, that is the current financial year, amounting to 20,480, meaning that accumulated depreciation will be 20,480 times it by 147,600. It'll give us 168,080. Now our carrying value will now be 102. It'll be 250 minus 168,080 which will be 81,920, or you take the 102,400 minus that year's depreciation of 20,480, and you will still get that 81,960. So basically here we're saying that depreciation, when we use diminishing balance method, we calculate it using last year's closing value of your carrying value, or basically the opening carrying value, because last year's closing will be this year's opening. You take it, you multiply it by your depreciation rate, you apportion it according to the number of years, not years, of months you've used that asset in that year. Depreciation, now I think that I meant to say accumulated depreciation is the sum of depreciation of an asset from when it was purchased up to now, or the date it is sold. Let's get to this one here. So we've got WA, which is Pty Ltd, Women of Africa. They purchased a truck for 1,500,000 on the 30th of August 2019. The truck is depreciated at 20% on cost. Okay, highlight that because it's key. It means whenever you calculate depreciation, you will just take the cost price and multiply it by the depreciation rate of that 20%. And then it says on 1 December 2020, truck was above its carrying value. We need to complete the asset reversal for the year ended 20th of February 2022. Note that if our financial year ends in February or on the 28th of February, it means it started on the 1st of March. Let's look at the year this asset was purchased. This asset was purchased on the 30th of August 2019. I mean, after the 30th of August 2019, the next Feb will be the 28th of Feb 2020. Right? That will be the end of the of the first year. It will be the 28th of February 2020. Now we need to depreciate it for that year. And notice that it was purchased in August 2019. But we need to depreciate it according to when our financial year ends, which is the 28th of February 2020. For that year, let me just draw the timeline for you. For that year, our year started on the 1st of March 2019. It ended on the 28th of February 2020. This asset was purchased on the 30th of August 2019. It means that this asset was only used for this period, from when it was purchased until the end of that year, which is the 28th of February 2020, meaning that it was only used for 6 months. So when we depreciate it, because they said we depreciate on cost, we will take 1.5 million times it by the depreciation rate of 20% times it by 6/12, because it was only used for 6 months that year. So when we record it in our asset register, we are going to have that 1.5 million times 20% times by 6/12. It'll give us 150,000. Accumulated depreciation for that year will be the same as depreciation for that year, which is 150,000. Carrying value will be 1.5 million minus 50,000 which will be 1,300,000. The next financial year runs up to the 28th of February 2021. Remember, by that year, we would have used this asset from the beginning of the year. So the beginning of that year will be the 1st of March 2020. It will run up to the 28th of February 2021, meaning that for that year, we've used this asset for the entire 12 months. So when we depreciate it, we'll depreciate it over 12 months. By taking the cost price multiplied by the depreciation rate of 20%. Now, our depreciation for that year, the 2021 financial year, will be 300,000 rand, increasing our accumulated depreciation to 450,000 rand. How did I get that 450,000 rand? It's accumulated depreciation from the previous year plus current year depreciation of 300,000. It'll give us 450,000. The carrying value, you have two options. You take the cost price minus accumulated depreciation. It will be 1.5 million minus 415,000, and that will give us 1,50,000. Or you take last year's carrying value or opening carrying value, you subtract this year's depreciation, it'll still give you that 1,50,000. Before I go to 2022, I noticed something. They said on the 1st of December 2021, the truck was sold. I don't care about how much. That won't affect our depreciation because what matters the most here is depreciation. It means this truck this truck didn't reach the end of the 2022 financial year. So if the year end was the 28th of February 2022, this truck was sold on the 1st of December, so we only used it from the beginning of the year up to the date of sale. So we only used it for 9 months: March, April, May, June, July, August, September, October, November, December. Okay, that's 9 months. It's I don't count December because it's on the 1st. So it's March, April, May, June, July, August, September, October, November, December we don't count. So it's 9 months in total. That will be because we've used it for 9 months in that 2022 financial year. That 9 months depreciation must be recorded in the asset register as such. Okay, now I'm showing you classwork 2. So it was sold on the 1st of December 2021. It means it was used only for 9 months. Cumulated depreciation will go up to 675,000, and the carrying value will be 825,000, which was 1.5 million minus 675,000, or 1,50,000 minus 225,000. I've showed you all these workings here. Let us go to classwork 2. I see the beginning of the year is no, that's not the beginning of the date of purchase is 1 November 2018. The end of the year will be the 28th or 29th of February, meaning that this financial year started on the 1st of March 2018, and it ended on the next 28th Feb will be in 2019. So the end of the year will be 28th of Feb 2019. When we calculate depreciation, I'm going to count from November that year. How long did I use this asset? End of the year, beginning of the year when the asset was purchased. So I used it for 4 months. So it will be 1.2 times 25% times 4 over 12. So it was used for 4 months that year. It was used from the 1st of November. So when we're looking at one thing the pattern that I see here is that when an asset is purchased, you check when was it purchased and you depreciate until the end of it. And when it is sold, you start by depreciating it from the beginning of the year until the date of sale. So it won't reach the end of the year unless it was sold right at the end of the year. When we calculate depreciation here, our annual depreciation will be 100,000, same as accumulated depreciation. Carrying value will be 100,000, 1,100,000, sorry. Please note that here we're still depreciating using the diminishing balance method. So I'm going to take last year's carrying value in 2020 to calculate my depreciation. And that will give us 275 added with 100,000 will give us 375. Carrying value will be 1.2 million minus 375,000, which is 825,000. 825,000, we're going to times it by, because this asset, I see that it was sold on the 1st of July 2020. So for that year, it was used for July, August, September, October. No, it was used for March, April, May, June, beginning up till the date of sale. Remember when it sold, because it was there already from the beginning of the year. It's March, April, May, June. I don't count July because it's on the 1st, which is 4 months. So it means that even when it was sold, in the year it was sold, this asset was only used for 4 months. Just to give you a diagram for you to understand what I'm talking about. In 2020, it was depreciated for the entire year. We use the carrying value of the previous year to calculate depreciation for the current year. And in the last year, it was used from the beginning of the year until the date of sale, which we said was 4 months. So carrying value at the beginning of 2020 was that 825,000. You times it by 20%, times it by 4 over 12. Which will give us 68,750 added with 375,000. You will get 443,750. Carrying value will be 1.2 million minus 443,750. It will give you 756,250. Let's look at this example where we have Very Mark trading as Very Tezu Stores. Started his business on the 1st of March 2019. On this day, he bought a vehicle for 300,000 and equipment for 200,000. He paid by EFT for both items at the end of the financial year, that is the 28th of February 2020. Depreciation on both fixed tangible assets must be brought into account as follows. So we've got vehicles at 20% per annum, highlight per annum on fixed installment method, which is the straight line basis or the cost method. And on equipment, it will be 25% per annum according to the diminishing balance method. So that is basically taking your carrying value multiplying by To calculate depreciation on this, because it is new and we need to prepare the general journal for February 2020, everything is new here because they've just been bought. They were bought on the 1st of March 2019, which is when the business started. And to calculate depreciation, you will calculate it by multiplying the rate with the cost of the asset. Let's start with vehicles. So for vehicles, you will take 300,000 times it by 20% times it by 12 over 12 because it was used for the entire year. That will give you 60,000 rand. And for equipment, it will be 200,000 times 25%. And that will give you 50,000 rand, which is your depreciation on equipment. How do we record all of that in the general journal? We debit depreciation because it's an expense. Instead of crediting the actual asset, you credit what we call accumulated depreciation. And I did explain earlier on as to why that is the case. You will credit accumulated depreciation on vehicles by that 60,000 and accumulated depreciation on equipment by that 50,000 rand. The depreciation is an expense, that's why it increases on the debit side. Accumulated depreciation is a reduction of the cost price of an asset. It therefore increases on the credit side whenever depreciation is recognized. When you add these two, they will give you a total depreciation for the year, which was 110,000. Write the narration there explaining the depreciation methods. In your general ledger for vehicles, because you've just purchased this, you'll just have the day you purchase the asset. Bank, it was purchased for cash. CPJ, the amount will be 300,000. Vehicles are assets. Assets increase on the debit side. Vehicle account will increase whenever you buy. Whether you're buying for cash or you're buying on credit, it will always increase whenever you buy. Similarly, with your equipment, it will increase on your debit side whenever you buy. We bought this, so the CPJ, the amount will be 200,000 rand for equipment. Accumulated depreciation, the sign for accumulated depreciation will be minus plus. It increases on the credit side, and that is because I said to you, it represents reduction of your asset. That's why it increases on the credit side. I refer to it as a valuation allowance. It'll only be increased by the accumulated, it'll only increase by depreciation because it accumulates. And when it accumulates, it will accumulate on the credit side. Here, I will increase this by the depreciation for the current year, which was 60,000 rand. On equipment, I will increase it by the depreciation for the current year, which will be 50,000 rand. I will do the balance carry downs later on. For now, I'm just showing you the basics. Now, depreciation is an expense account. So the sign for depreciation will be plus and minus. It increases on the debit side, it decreases on the credit side. So for depreciation, you have accumulated depreciation on vehicles and accumulated depreciation on equipment. Later on, you will notice that we close it off against profit or loss because it's an expense account. In the income statement, when you recognize depreciation, you will add current year's depreciation, which will be that 60,000 rand plus the 50,000. And that will give you 110,000. What you can take from this is that accumulated depreciation increases on the credit side whenever we recognize depreciation, and depreciation will increase on the debit by the depreciation on all your assets for the current year. So you debit depreciation, you credit accumulated depreciation. Both depreciation or depreciation on all your assets will be added up and recorded under operating expenses in the statement of profit or loss. Let's go to the tangible assets. This is your tangible asset. Notes is divided into three parts. The top part and the last part are pretty much the same. It's cost and accumulated depreciation as well as carrying value. The top one is at the beginning of the year and the bottom one is at the end of the year. Under movements, we only have three things: additions, disposals, and depreciation, as I have mentioned earlier on the video. Now, the cost of equipment at the beginning of the year was zero because we don't have any equipment that we are carrying from the previous year. We don't have any accumulated depreciation that we are carrying from the previous year. However, we purchased equipment at the beginning of the year and the cost of that equipment was 200,000. So that will be recorded under additions and cost. Please note it's additions and cost. Disposals at carrying value. Carrying value is just cost minus accumulated depreciation. If we had disposals, we were going to put them in brackets, but we didn't have any. Instead, we have depreciation. I'll just put that in bracket, which was 50,000. Now, movements will be that 200,000 minus 50,000, right? So your movements in total, you put the total at the top of that big shaded box. It'll be 150. That 150, I got it by taking 200,000 minus 50,000. So our net movement will be 150,000. Note that at the beginning of the year, we didn't have any cost. So cost at the end will be cost at the beginning plus cost of any asset purchased or additions minus cost of disposal. Here, cost at the beginning of the year was zero. We don't have any disposal. All right. As I've said, cost will be cost at the beginning plus cost of the addition minus cost of the disposal. And cost at the beginning will be zero. Cost of additions will be 200,000. Cost of the disposal will be zero. So it's 0 plus 200,000 minus 200, minus 0, which will give you 200,000. Depreciation will be 50,000, which is, we put it in brackets because it reduces the value of your asset. Hence, when we calculate accumulated depreciation, we're going to use this formula here, which is cost balance at the beginning of the year plus current year depreciation minus accumulated depreciation of sold. So balance at the beginning of the year will be zero. Current year depreciation will be 50,000 and accumulated depreciation of sold will be zero because we didn't sell anything. We didn't sell any equipment. So our accumulated depreciation at the beginning, at the end of the year will be 50,000. So accumulated depreciation is only increased by current year depreciation, just remember. When we look at vehicles, obviously carrying value will be 200,000 minus 50,000, which will give you 150. Similarly with vehicles, cost at the beginning will be zero. Accumulated depreciation at the beginning will be zero. Carrying value at the beginning will be zero. Under movements, we have additions. We bought vehicles worth 300,000. We did not sell any vehicles, so disposals at carrying value will be zero. We did have depreciation on vehicles, which was 60,000. We put it in brackets because depreciation reduces the value of our vehicles. So movements will be made up of 300,000 minus 60,000, which will be 240,000. It's positive. Cost at the end is made up of cost at the beginning, which is zero, plus cost of additions, which is 300,000, minus cost of the sold, which is zero. So cost at the end will just be 300,000. Accumulated depreciation at the end will be balance at the beginning of accumulated depreciation was zero, plus depreciation of 60, minus accumulated depreciation of assets sold, which is zero. So our accumulated depreciation at the end of the year will be that 60,000, right? Which is just current year's depreciation. When you take 300,000 Rand, you minus 60,000 Rand, it'll give you 240,000. This is for future reference. When you take that carrying value there and you add it with your movement here, whether negative or positive, it should give you that. So 0 plus 240, it'll give you 240. But remember how I got that 240? I just took the 300,000 and then I subtracted the 60,000. Similarly, for me to get that 150, I took the 200,000 minus the 50,000. So there are two ways of getting carrying value at the end of it. Okay. All right. Let us move to example 2. It is the same scenario, same assets, except now they have accumulated depreciations from the previous year. So when we depreciate our vehicles, you will need to draw the timeline. This financial year is the 1st of March 2021 up to the 28th of February 20. If they say on the first day, which is the 1st of March 2021 of the second year of the trading, very Tsebo stores will have the following balances. So it means that our financial year here will start on the 1st of March 2020. And it will end on the 28th of February 2022. It starts on the 1st of March 2021 and ends on the 28th of February 2022. The first thing that you do, guys, is to calculate, before you calculate depreciation for the current year, it doesn't matter what type of depreciation method you use. Make sure you calculate carrying value at the beginning of the year. By looking at the cost at the beginning of the year, in this example for vehicles, it will be 300,000. Then you minus accumulated depreciation on vehicles at the beginning of the year, which will be that 60,000. It will give you the carrying value at the beginning of the year, which will be 240. Now that 240 simply advises or guides you in making sure that current year depreciation doesn't exceed. You need to make sure that current year depreciation does not exceed carrying value at the beginning of the year. If it does, you need to limit it at carrying value at the beginning of the year -1. So that is why it's important to calculate the carrying value. Just because depreciation is on cost price, a lot of students don't calculate carrying value at the beginning of the year. And it has nothing to do with depreciation. You need to calculate it to ensure that current year depreciation does not exceed carrying value at the beginning of the year. All these assets, specifically this vehicle, was used for 12 months. So when we depreciate it, will I take 300,000 or will I take 240,000? I will take 300,000. Why? Because we are depreciating on cost price or fixed installment method, which requires depreciation to be calculated by taking the cost price and multiplying it by the depreciation rate and multiplying it by the number of months the asset was used divided by 12, which will be 300,000 times 20% times 12 over 12, and that will give us 60,000 rand. This will be a depreciation for vehicles in the current financial year, which is the 2022 financial. You will notice that 60,000 is way less than the 240,000, which was the carrying value at the beginning of the year. So that calculation that I highlighted, that value that I highlighted, it's important in making sure that our current year depreciation does not exceed that value. If it does, we limit it to that value in red minus 1. So let's say our current year depreciation was 250. It means our depreciation for the current year was going to be 240 minus 1, which was going to be 239,999. We limit it to the carrying value at the beginning of the year minus 1. Now let's calculate depreciation quickly. Beginning of the year is the 1st of March 2021. It ends on the 28th of February 2022. Equipment is depreciated on diminishing balance method or carrying value method. The same principle applies. You calculate carrying value at the beginning of the year. By taking the cost price of equipment, you minus the accumulated depreciation of equipment at the beginning of the year, then you will get carrying value at the beginning of the year of 115. Indicate for how long this asset was used in the current year. It was used for 12 months. However, when we depreciate it, we are going to depreciate it on diminishing balance method. When we calculate depreciation on diminishing balance method, which value are we going to take? Are we going to take the 200,000? Or are we going to take the 150,000? But we'll take the 150,000. 150,000 times 25% will give us 37,500. So indicating that current year depreciation does not exceed carry value at the beginning of the year. When we record it, just like in the previous example, you will debit depreciation because it's an expense. Then you credit accumulated depreciation on equipment, as well as accumulated depreciation on vehicles. By current year's depreciation on vehicles and equipment. For equipment, it was 37,500. 37,500 plus 60,000 will give you 97,500. Vehicles are assets. We didn't buy any vehicles for this year, so our balances will remain the same. Accumulated depreciation on vehicles, the sign for that will be minus plus. So at the beginning of the year, accumulated depreciation on vehicles amounted to 60,000. Remember what I said, accumulated depreciation will only be increased by depreciation. For 2022 financial year, our depreciation was 60,000. So the accumulated depreciation account will increase on the credit side by 60,000, taking it to 120,000. That 120,000 will become our balance carried down and ultimately our balance brought down. Try the accumulated depreciation on equipment. The signs will be minus, plus. The balance at the beginning of the year will be 50,000. Will it increase or decrease? It will increase. On which side? On the credit side. By how much? By 37,500. Taking our accumulated depreciation on equipment to 87,500. You will write it as balance carried down and ultimately balance brought down. This is a statement of financial position account. That's why it has a balance carried down and balance brought down. A vehicles account is an expense account, which will be a plus, minus. It'll increase by current year depreciation, made up of accumulated depreciation on vehicles of 60,000 and accumulated depreciation on equipment of 37,500. Normally, we will close this off against profit or loss. In your statement of profit or loss, you will only record current year depreciation, which will be the 60,000 added with 37,500. So current year depreciation will be 97,500. I want to do the accounting equation. For accounting equation, note that accumulated depreciation reduces your asset and depreciation reduces your owner's equity. Liabilities are not affected here. Recording this in your tangible asset note, remember it's divided into two. What is the cost of equipment at the beginning of the year? It's 200,000. You will minus accumulated depreciation at the beginning of the year of 50,000. Carrying value will be 200,000 minus 50,000, which will be 150,000. We did not buy any equipment, so additions at cost will be 0. We did not sell any equipment, so disposals at carrying value will also be 0. For current year, depreciation on equipment was 37,500, put it in brackets. That is the only movement we've got. That's why for net movement, we will have only that 37,500 in brackets. Cost will remain the same because cost at the end is cost at the beginning plus cost of additions, which is 0, minus cost of disposals, which is 0 because we didn't buy any equipment and we did not sell any equipment. So our cost at the end will still be 200,000. Accumulated depreciation on equipment at the end of the year will be balance at the beginning of the year is the 50,000. Current year depreciation is 37,500. So I've got 50,000 plus 37,500 minus accumulated depreciation of assets sold. There's no asset that was sold here. So accumulated depreciation at the end will be 50,000 plus 37,500, which gives us 87,500. Carrying value at the end of the year will be 200,000 minus that 87,500, which gives us 112,500. What is cost of vehicles at the beginning? It is 300,000. Accumulated depreciation is 60,000. Carrying value at the beginning of the year will be 300,000 minus 60,000, and that'll give you 240. Under movements, we have no additions and we have no disposals. We do have current year depreciation. Depreciation will be recorded in brackets. It will be 60,000. Your net movement will still be that bracket 60,000. Cost at the end will be 300,000 plus 0 minus 0, which stays the same, 300,000. Accumulated depreciation at the end of the year will be 60,000 plus 60,000, which gives us 120,000. $300,000 minus 120,000 will give us 180,000. That 180,000, you could have got it by taking this 240. You subtract the 60 because it's in brackets, it'll give you 180,000. These two carrying values at the end of the year, you will add them up and record them in your statement of profit or loss under non-current assets as tangible assets at carrying value, which will be 292,500. This represents the value that is still left in our assets, the value that we can still derive from using our assets in the future. That's what that 292,500 represents. So it qualifies to be a non-current asset, which will be derived through usage. We will derive benefits from this non-current asset through usage, through using the asset. Okay. Last example. So here we've got vehicles. Everything here is 1 March 2022, which is the beginning of the financial year. So it ends on the 28th of February 2022. Let's start with vehicles. I'm going to go straight to it. Don't have that much time. Vehicles are depreciated on cost method. So our financial year will start on the 1st of March 2022 and on the 28th of February 2023. We depreciate vehicles on cost method. I am going to, for now, because we are told that there was an asset that was purchased, a vehicle worth 150,000 Rand. But this 150,000 Rand was purchased on the 1st of September 2022. I need you to understand that these balances that we have in the pre-adjustment trial balance are balances at the beginning of the year. So that 600,000 Rand does not include this 150,000 Rand, because this 150,000 Rand only came into existence on the 1st of September 2022 when we purchased this vehicle. So I will first start by depreciating the vehicles that we already had. Their cost price at the beginning of the year amounted to 600,000. Their accumulated depreciation at the beginning of the year amounted to 240,000. And their carrying value at the beginning of the year amounted to 360,000. I'm doing this so that I can start depreciating this asset. Because these vehicles, we already had them at the beginning of the year, and none of them were sold, it means we had them for the entire year. So we will depreciate them for the entire year. Which value do I take though to calculate depreciation? Do I take the 600,000 or do I take the 360,000? You will take the 600,000. Why? Because they told you that we depreciate vehicles on cost price. That is the only reason. This will give us 120,000. It doesn't exceed carrying value at the beginning of the year. If you're wondering, but why do we need to calculate carrying value at the beginning of the year if we only needed the cost price, which is 600,000? We needed it to make sure that current year depreciation does not exceed carrying value at the beginning of the year. Because if it does, it will mean that we have a negative asset. And that cannot be. We can't have a negative asset. That's why I don't like it when we use negative asset or refer to accumulated depreciation as a negative asset. Now I'm going to go to the new vehicle that we purchased on the 1st of September. We purchased it during the year. So when we depreciate it, we'll depreciate it from the purchase date to the end of the year. It wasn't there at the beginning of the year. So we only had it from the 1st of September until the end of the year, which is the 28th of February. In essence, we've only used it for 6 months. When we depreciate it, we will take cost price of this asset, which is the 150,000, times it by the depreciation rate of 20%, and that will give us 330,000. Actually, it's 15 because you divide it by 2. So on this new vehicle, depreciation will be 15,000 rand. And the statement that I wrote there really doesn't matter because this asset doesn't have carrying value at the beginning of the year. I'm done with the depreciation of vehicles. Let us go to the depreciation of equipment. No equipment was sold or was purchased. So when I draw my financial year, I will do the same thing, calculate the cost, the carrying value, which is cost minus accumulated depreciation at the beginning of the year. Cost is 400,000. Accumulated depreciation on equipment is 175,000, giving you a carrying value of 225,000. We used equipment for 12 months. So which value are we going to take when we depreciate equipment? Are we going to take the 400,000 or are we going to take 225,000? We are going to take 225,000. And because we've used it for the entire year, multiply that by 12 over 12, which will give us 56,250. How do we record it? This is to ensure that it doesn't exceed carrying value at the beginning of the year. To record it, we debit depreciation because it's an expense. Then we credit accumulated depreciation on vehicles, which is 135,000, and on equipment, it was 56,250. Someone might be wondering, where did you get that 135,000? Remember, for old vehicles, the ones that we had from the beginning of the year, we calculated depreciation on them as 120. And then there was a vehicle that we purchased and we used for 6 months, and depreciation on that was 15,000. So that's how we got that 135,000. It is basically the sum of depreciation of both types of vehicles we've got. The ones we have always had and the one we only purchased in the current year and we've used for 6 months. So it is that 120 plus the 15,000. In the general ledger, Remember, vehicles are assets. They increase on the debit side and they decrease on the credit side. At the beginning of the year, we had vehicles amounting to 600,000. Then we purchased another vehicle worth 150,000. They didn't specify how we purchased it. So equipment will still remain the same, which will be the 400,000. We didn't purchase any equipment. But for vehicles, it'll change because in September the 1st, we purchased a vehicle. They didn't mention how we purchased it. If it was EFT, we were going to write bank, CPJ. If it was invoice or on credit, we were going to write creditors control or CJ, but it wasn't mentioned, so I will write both. It was purchased for 150, meaning that the cost price of our vehicles will no longer be 600,000. Instead, it will be 750,000. Because this is an asset, we have to balance it off by recording or calculating balance carried down, which will ultimately become balance brought down. So the cost price of vehicles when we start the 2024 financial year, the beginning of 2024, it'll be 750, and for equipment, it'll still be that 400,000. When we record this, accumulated depreciation on vehicles amounted to, this is, by the way, is the balance we had from the pre-adjustment trial balance. It amounted to 240. We are going to increase it by 235,000. Do you remember where we got the 235,000? It is the 120, which is the depreciation on vehicles we've always had, and the 15,000, which is the depreciation on the vehicle that we just purchased, which increases, as I've said earlier on, accumulated depreciation is only increased by depreciation. Balance it off because this is a financial position account section. And remember, it's a minus plus, okay? It goes up on the credit side. Similarly, on equipment, we are going to do the same principle, balance of equipment at the beginning, for accumulated depreciation on equipment at the beginning. It was 175. We're going to increase it by the depreciation for the current year from the general journal, which was 56,250, taking our accumulated depreciation up to 231,250. Which will become our balance carried down as well as our balance brought down. Depreciation, as I've said, is an expense account. It's a plus minus. Sorry for that. Made up of accumulated depreciation on equipment and vehicles. On vehicles, it was 235,000, and on equipment, it was 56,250. When you add the two, it'll give you our total vehicles expense, of which we will take to profit or loss. I don't know why I didn't do it here. In profit or loss, it'll be the sum of the two, which is 135,000 plus 56,250, and that will give you 191,250. Tangible assets. It has three parts, remember? So cost of equipment at the beginning hasn't changed. It's 400,000. Accumulated depreciation was 175. Carrying value will be 400,000 minus 175, and that will be 225. Under movements, we did not buy any equipment. We did not sell any equipment, but depreciation on equipment was 56,250, which is our net movement. Cost at the end will remain the same because we did not buy any equipment or sell any equipment. So it'll remain the same as 400,000. Accumulated depreciation, though, will be the 175 accumulated depreciation at the beginning of the year plus current year depreciation of 56,250. Carrying value at the end will be 400,000 minus 231,250, which will be 168,750. Cost of vehicles at the beginning of the year were 600,000. Accumulated depreciation at the beginning of the year was 240,000, which gave us carrying value of 360,000. That 360,000, I got it by taking 600,000 minus 240,000. Under movements, I will have additions, which is the cost of the vehicle that was purchased, and that will be 150. There is no vehicle that was sold, but we do have depreciation on vehicles, which amounted to 235, which was the 120 of old vehicles of the 600,000 and the 15,000 of the new, which is this 150,000, because it was used for only 6 months. Your net movement will be that 150,000, 150,000, because the depreciation reduces the value of your vehicles. We are going to subtract 135,000. It gives us 15,000, which is your net movement. Cost at the end will be cost at the beginning 600,000 plus cost of additions 150,000, and that will give you 750,000. Accumulated depreciation at the end will be accumulated depreciation at the beginning, which is 240, plus current year depreciation, which is 135. There was no asset disposed, so it'll be 240 plus 135. That'll give you 375. To get the carrying value at the end of the year, you will take the 750 minus the 375, and that will give you 375. So when you add these two carrying values, you're going to add them up and then take them to non-current assets and record them as tangible assets at carrying value, which is the sum of the two, which will be 543,750. Okay, try this classwork. To prepare this, this will be classwork 2. Okay, that will be the end of your classworks. And then in our next lesson or next video on tangible assets, this is what we will be talking about. And obviously giving you corrections to the classworks that I gave you. And this is the example we will be busy with, which is about assets disposals. All right, check the next video on tangible assets for corrections to classwork 1 and 2, and for our discussion on example 4, which involves the disposal of an asset. Thank you for watching. Kgotso.